This is a video in which I'm going to talk about trading costs or also expenses that you will occur when trading. So the first one will be your spread, and for spread, this will be the main cost that brokers will charge you. So spread will just be the difference between the two lines on your prices. Once you have selected for you to have both the bid and the ask price on your chart, so spread now will be the difference between that green and that red line, which is just the price with which you will open a trade right now. And if you were to immediately close the trade, the other line which will be in the worst case will now be the second price level which you would close the trade, meaning that if you would have a small loss of the spread, which is just a charge which the broker charges you as more of a commission for them to open and close your trades. That's why whenever you open a trade, you open it within a small loss, which will be with of your spread. And then for spreads, now you will know that sizes of spreads will differ between different asset classes when trading financial instruments like forex for your currencies or the stocks or whatever. The asset classes which are the groups within the asset class which are traded more will have smaller spreads, because there will be more people trading them, more institutions trading them. So there will be more liquidity, and there will be more bigger number of trades traded each day. So there will be more volume, and that's why there is competition within trading them, which makes the trading costs of the spread to be smaller. So the smaller the spread is, the less the transaction costs you will have, and then the bigger the spreads is, the more the transaction costs that you will have. Now for your spread, you should know that there are brokers which offer just fixed spreads where the size of the difference between those two lines does not change regularly. And then there are also what's also known as floating spreads or variable spreads. Floating spreads or variable spreads are now when the spreads can increase or decrease significantly even throughout the day. Now with derivative synthetic indices, when trading volatility indices or other synthetic indices, you have more of fixed spreads. If you come to the properties, you will see that where it's written spread, it's an actual amount written there, and it won't be written floating like what many brokers would offer in financial instruments. Now when trading maybe stocks, bonds, or other financial instruments of real world markets, although you should note that with derivative, the spread may change maybe on certain days, but that same spread maybe could apply for a few days or maybe for the whole day, and the change won't be too different, but they are actually just more of fixed spreads for synthetic indices. So the advantages with fixed spreads is that, of course, you will have more of less transactional cost, and then you will also have an advantage that, especially if the regulation of the broker is strong, you will not be manipulated your trades in the spread being widened when it is in your worst case scenarios, like when maybe your spread and price is now approaching your stop loss, or even when approaching take profit. You will see that for some brokers, especially the ones with weak regulation, if price is now approaching your stop loss, and if especially a big booking broker, and especially in the time where they would not have yet classified you as a profitable trader, and they will still be booking your trades, they could enlarge the spread when it reaches near your stop loss, so that they take your trade out and make you close your trade in a loss. Or also they could, if price is now in profit and approaching your take profit level, could widen your spread so that there will be a slight delay in closing of your trade if they are floating spreads or variable spreads. So you will not have that form of disadvantage when trading with fixed spreads, either here on derivative synthetic indices or on financial instruments with other brokers which may offer fixed spreads. Brokers which may offer fixed spreads will usually be brokers which also charge commissions. Besides spreads, there's another charge also called commissions, which I shall explain later. Now you should also note that the spread, its charge, will also increase if you increase the lot size with which you open your trade. Lot size, which is just the quantity of the amount of instrument you are opening your trade with. So if you use a bigger lot size when opening your trade, okay, the distance of your spread will also be multiplied with that lot size, meaning that your cost of spread will increase in proportion to the lot size that you will use, which will be just same applies for the distance which with price will move, as it will also be determined its profit or loss, its size, by the lot size that you use. Now, the disadvantage with fixed spreads is that if you try to open a trade, and in case if price would have moved very fast, or especially if there will be news events which cause volatile market conditions, which price just moves rapidly up or down, the broker may requote you and refuse to open your trade, but then offer you to open maybe the trade at a different price level, because they will not be allowed to increase the spread to try and compensate for the very fast price movement which may have occurred, either maybe during a very fast movement in price, which sometimes can be caused by news events, or sometimes can just happen in volatile market conditions. Now, the other type of spreads will now be your variable spreads or floating spreads. So your variable spreads or floating spreads will now be when the broker is not restricted to using the same amount of points of spread, like here as you see. Those are the spread points. You can actually see that they are even changing. So usually for financial instruments, brokers will offer variable spreads because it gives the advantage that even if price moves just as soon as you open your buy trade in fractions of a second, the broker can compensate to open your trade with less slippage by just increasing the spread costs. And it also gives an advantage when using floating spreads, that now when you are using limit orders or stop orders instead of market execution, where you are waiting for price to reach a certain level so that the trade will be opened even when you are no longer on your device, but when you have automatically told MetaTrader to open a trade when price reaches that level, you have a better chance of your trade being opened if your broker uses floating spreads, because in case if price does not really reach the price level exactly that you want to open your spread, your trade, the broker can just open at a price which is at least closer to that price level, and then try to compensate by increasing the spread charge slightly, so that at least your trade will still have a higher guarantee of being opened with a smaller slippage. Slippage is just when your trade is opened at a different price level than when your market order or your limit or stop order would have instructed MetaTrader to open the trade, the price which you would have actually selected to want the trade. So slippage can be caused maybe if there is low liquidity in the markets that you trade, or if they are low liquid markets, okay, like maybe markets which are less commonly traded, or even also if they are markets with less volume at those times of the day, or maybe groups within asset classes which are also less traded, like your exotic currency pairs in forex, or your small cap stocks in stocks or equities. So for Tesla, for this financial instrument which is a stock, you can actually see that the spread here is floating. Now for you to try and estimate your trading cost for spread on instruments with floating spreads, you can just maybe regularly check the smallest to the biggest spreads that you would have seen over time, and then you can just try to accommodate them. Now the disadvantages with floating spreads is that if price may reach close to your stop loss level, let's say you were in a sell trade and your stop loss level is there, if price can reach near your stop loss level, some brokers may widen the spread so that they take your stop loss, so that your trade will now be closed in a loss. But usually brokers who do that may be brokers with weak regulation, which is not tier 1 or 2 level, and maybe especially also if they are booking brokers, and also especially maybe if it will be the period that they would have not seen that you are a profitable trader. Once they have seen that you are a profitable trader, especially for financial instruments, they will now be forwarding your trades to the actual market. So there will be less conflict of interest then, and they might no longer do much manipulation. Although there are some brokers who may still hedge positions of even profitable traders, because they have large amounts of money, they can even open trades and just wait to close them whenever price returns to that price level, even if it takes a long time, because brokers will have very large amounts of money, and then they could still try to, in a way, maybe act as if they are booking even profitable traders, although it is less brokers who will do that. Now, the advantage with trading with floating spreads is that you have a higher guarantee for you to have your orders filled, just meaning to have your trades opened. And also you will have less slippages, because even if there is a bit of lower liquidity or volume in the market that you trade, or the group of the asset class you are trading, the broker may just compensate a bit by increasing the spread instead of giving you a slippage where your trade, instead of where the spreads are right there, maybe price may be opened at a higher level. Because with slippage now, sometimes you won't know if the slippage may be positive or negative slippage, meaning that you won't know in which direction it will be, whether it will give your trade an advantage or a disadvantage. Because obviously, if you are opening a buy trade and compared to where the spreads are, if that is where price is, if it's a buy trade and the trade now gets executed there above it, you will be in a disadvantage because you would have lost out on that profit. But if it was opposite case, where on a sell trade where you are trying to predict price to go down, the trade now will be executed above where you would have placed your order. It will be an advantage for you, because by the time that price shall decrease to go down in your favor, that will be an extra profit. So that will be positive slippage. Then the other advantage now with the variable spreads is that also now, if you are using limit orders or stop loss orders for you to open your trades, where you are telling MetaTrader to open a trade once price reaches a certain price level, even when you are no longer on your device, you have a better guarantee of your order being filled. Because even if price fails to reach the exact price that you set automatically for your limit or your stop order, the broker could execute your trade at a price which is closer to that price, and then he may just compensate for himself by increasing the spread slightly, and you will also have less slippage. If you let your trade continue to be open beyond the beginning of the next day, we also have what are called swap fees. So swap fees may be charged maybe with some brokers around 5 p.m. New York time, EST time, and then with some brokers it may be around 11 p.m. to midnight of the server time which the broker uses. But you can still just go to the properties of the instruments on your broker, and then you can check the trade sessions, and then at the end of the day is probably when your swap fees will be. Actually, if you use, I think maybe the court sessions, the end of that day, I think maybe better times to use. But you can always just even confirm with your broker by just asking in support. Now, the amounts which they will charge you with will be written even here on MetaTrader. And then even another source which you can find your swap fees can also be on your broker's website. They also will include them there and will probably even offer you a table on a separate page on their website where you can see the swap fees. Now, swap long is when you are open. If you had opened a buy trade, if you exceed your trading to the next day whilst it is still opened, you would be charged minus 1.4. If for stocks, I'm not sure exactly what it will be, but you can always open a trade on your demo account and see what the units will be. But for currencies, swap fees are usually charged with percentages of interest rates. Now, if I go to currency, actually, if I go back and go to the properties for GBP USD currency, swap long, if it's a buy trade, will be minus 2.42. So that could be your swap if you would have opened a buy trade. So you can always even check with your broker's website just to check and make sure that the readings will be the same. And then also, if you are someone who's going to be doing trades which exceed into the next day for more than a day, like in short-term trading and swing trading, you can always practice in your demo accounts to see how your swap fees will affect your trading. And you always have to make sure that you include those potential costs with the average number of days that your trading strategy may last, which you would have to have taken note of in your back tests. And you should also know that for swap fees now, when trading currencies, you may actually gain money from swap fees if the base currency, which is the first currency on a currency pair, which is Great British Pound in that case, will have a bigger interest rate compared to the second currency in that currency pair, which is your quote currency. If the GBP will have a bigger interest rate than the US dollar, and especially if the US dollar will have a negative interest rate, if you had opened a buy trade, the broker will actually give you a small amount of money which will be added to your account. So it will actually be a positive swap. It will no longer now be a trading cost. But if you open a buy trade and the Great British Pound has a smaller interest rate than of the second currency, which is the quote currency, you will be charged a small fee. But usually interest rates will be very small charges, that when you are doing short-term trading, in which your trades last just maybe more than a day to a week, they will be very insignificant. But maybe you might have to be more mindful of them if you do swing trading or short-term trading, where, remember, in swing trading, your trades last more than a week to about 2 weeks up to about a month. And then not short term, but in position trading, your trades will now last more than a month, even up to a year or more. Now, for your swap fees, if you are trading financial instruments, your reward markets like forex, the currencies, or stocks, equities, for example, companies like Meta, Facebook, you should note that any financial instruments will offer 3 times the swap fees on one day of the week. This is because they will be trying to compensate for swap fees of the weekends for Saturday and Sunday, just in case your trade will be held into the weekend. So most brokers will offer 3 times the usual swap fees on Wednesdays, whilst maybe some brokers may offer it on Fridays. So you will have a bigger swap fee on Wednesday compared to other days with most brokers. Now, if you are going to open a sell trade, you will not be able to gain the positive swap where you actually gain money by opening a trade where the base currency has a higher interest rate compared to the quote currency. If you want to know more on swap charges and swaps, you can always do your own research. You will have some information on the internet, especially if you are going to trade futures versions of financial instruments. If you are not trading CFDs, the ones which we usually trade here on MetaTrader, if you are going to trade futures contracts, you may have also a different type of rollover or swaps when you are moving from trading one contract to another, when the other contract will be about to expire. Then the next trading cost you will have in trading is margin. Okay, margin is remember, we trade on margin. By trading on margin, meaning that we trade with leverage, because price fluctuations which happen in the market are very small. So the brokers give us an extra amount of money to boost the capital size of our accounts, and that is leverage. And leverage can increase your losses and also increase your wins. So you also still will have to be careful when using leverage. So margin now is the amount of money that you should just have in your account, even though the broker will let you use some of his capital for you to have more buying power. So this will now increase the losses or the wins on your capital, because remember, when exchange rates of instruments are moving, they are moving with fractions of pips or points. So you would need large amounts of money for you to trade without leverage, or what's also known as not trading on margin. Leverage is what helps us now to be able to trade with smaller amounts of money. But with certain brokers, if you don't want to trade on leverage, you can actually trade just with a cash account which does not trade on margin. Or with some brokers, you could actually select a leverage setting of 1:1, meaning that you really won't be using any leverage, and that will be probably more ideal, especially if you have larger amounts of capital, and it will reduce your risk for you to use less leverage. In the event that there will be a black swan event or an unexpected geopolitical event, be it a bomb is dropped in USA by terrorists or whatever, a sharp increase in price in the markets or decrease, which may cause panic in the markets in quotes, although usually to be market manipulation in disguise, that sharp movement in price will affect you less if you are not trading on margin, if you are not using leverage. The less the leverage you are using is the less that very sharp movement in price might affect you, because remember, those very quick movements in price or news events will not respect your stop loss. If your trade is going into a loss, your loss will actually encounter the whole distance with which price will move with, even beyond your stop loss, since price would have moved in just maybe a matter of a second or a few seconds. Now, when trading on margin, if you are using leverage, the amount of money that you are required to have in your account so you can open a position is called initial margin requirement. So now I'm just going to go to properties so you can see them on MetaTrader. Okay, so these are these ones, this section. Now, for you to understand them better, you would first have to check the minimum volume of your instrument. Minimum volume is just the smallest lot size with which you can open your trade. So now on margin rate, you can see the first one will be initial, then the second one will be maintenance. Initial margin is charged, not charged as such, but it is required soon as you open your trade. And then maintenance margin may be required if your trade exceeds to still be opened into the next day. Maintenance margin will not be charged on the same day that you open your trade. And even if it is charged when we go into the next trading day or beyond, it would have only been charged once. It will no longer be charged every day like what happens with swap fees, which I explained earlier. So your margin fees can be slightly different for buy trades and those of sell trades, although they usually will be almost the same. So since margin rates are showed in US dollars per a standard lot, okay, here it will be $1,274.86 for the initial margin, and then also $1,274.86 for the maintenance margin, because remember, it's US dollars per lot. So if you were to open a trade with a standard lot, which is 1.00 lot size, your account would need to have $1,274 for you to be able to just open your trade theoretically. But now, because brokers, we want you to have money which can maintain your order, and for brokers to take less risk in them loaning the money to us, most brokers will only allow you to open a position if you have at least twice the amount of money than your initial margin. So you will see when you go on your broker's websites that most brokers will demand you to have at least 50% of the amount of money with which you shall be trying to open a trade position in the markets. So if you to open a position with one standard lot, which is 1.00 lot, you are supposed with most brokers to have at least this amount times 2. This is if your trade will not exceed into the next day. If it is just a trade being opened and closed within that same day. Now, you will see now when you are reading the terms and conditions of your brokers that leverage may increase or decrease when maybe certain events might happen in the market. Maybe be it some world events, if they occur, the broker may increase or decrease leverage that compared to the setting which will be on your account in your broker's main back office. So because of that, I personally try to use even a slightly bigger account than just what is the minimum that is required by the broker. So for me personally, for trading trades which I don't hold into the next day, I trade if my account can be at least times 4 the size of the initial margin, so that if it's times 4, it will also be able to consider in case the broker may increase leverage, in case there will be some unexpected world events which might cause that increase in leverage. Now, for example, since the brokers who have settings where they require you to just have maybe for you to have at least twice the amount of the initial margin, I will only trade the instrument when my account only has 4 times the amount of money of the initial margin. And remember, for trades which are lasting only in that day. But if it's now a trade which I expect to last into the next day or more, I shall be charged maintenance margin. So in that case now, I will now only trade it if my account is 8 times the amount of money of any one of these, since usually the maintenance margin is usually the same as initial margin. But if it's an instrument where they will be different, I will add these two and then multiply them by 4. If it's a buy trade, remember, and then remember for sell trades, the prices may be slightly different. Now, since here it's written US dollars per lot, and since for the currencies the minimum volume is 0.01 lot, that's 100 times less than one standard lot. So it means that if you open a trade with the smallest lot size of 0.01 lot, instead of 1,274.86 dollars, your initial margin divided by 100 would now be $12 and almost 74 cents. So for me, I would just need, with FXView broker here, I would just need an account of $12 and about 74 cents times 4, which could be about maybe around $50 for me to open a trade which I don't plan on holding into the next day, where it will no longer be charged the maintenance margin. Now FXView broker, because it's an ECN broker, this is why it has bigger charges for margin. But you will see now that if I come to XS broker, which is a B-booking broker, which won't connect your trades to the actual market, but where the broker would have made their own market and they will be your counterparty, the margin will be less. Okay, minimum volume 0.01 lot. Okay, so here they actually have bigger charges for margin rates with XS. I'm not sure why. Let me see. Yeah, so surprisingly, XS actually has bigger margin requirements here. And I'm not sure, maybe if it's because of the time of day. So I'll check again later. But usually on most brokers, you will see that brokers which are B-booking brokers will have less margin requirements, especially if you check for deriv, the margin requirements will even be less. And then also, since for stocks, it may also be the same. And since XS now is B-booking, which would not connect you to the real market unless if later on they see that you are a profitable trader. Brokers which are B-booking for stocks may offer a smaller minimum lot size, although for XS they still offer minimum lot size of 1. But you will see that the margin requirements will also be less for stocks on B-booking brokers compared to A-booking brokers. Here it will be $21 per lot, almost $21. Then let's see for FXView, which connects you to the actual market by default, even from the get-go, I think. They might tend to have a bigger margin requirement here. So here it's actually $42 per lot. So remember that initial margin is the one you are charged when opening your trade. Now, what you should also know when we are trading on margin is that brokers have what is called a recommended margin level, which could be about 70%. Meaning that, for example, let's say you had a $100 account. If your trades go into a loss, okay, to reach $70, your broker may send you a message with your email or through MetaTrader of a margin call, which is just to warn you that your amount of money is decreasing in your open trade, even though the trade will not yet be closed, or the number of trades will not yet be closed, and they will be giving you a warning for you to deposit more funds into your account. But if now your trade continues to go into a loss until the amount of loss reaches $50 on your $100 account, on most brokers you will be stopped out now. meaning that your broker will close your trade or maybe some of your trades. Because remember, I told you that for brokers to reduce their risk of lending you money, they will want you to put some amount of money as more of a down payment, which will be margin. So most brokers require you to have at least some money, which will be about an amount of money in which double that will be able to cover your initial margin. So if let's say the total initial margin of your positions or all your positions was $50, the broker will want you to have at least $100 when trading. And if the amount reduces to now $50, they will close your trades. So for most brokers, you can see the minimum margin they require as your maximum by just typing stop out level. Usually it's 50% for most brokers. Okay, so you will see that it's actually written here, a stop out in Forex usually happens at the 50% margin level. And even with other brokers, usually they use that same one. But if some regulating agencies maybe might demand a higher stop out level if they offer more strict regulation. So now remember that even though your stop out level is 50%, when the broker will close your trade or some of the trades to their discretion of choosing which ones they will close, the broker will still have sent you a message either through email or MetaTrader or even both, when your margin level would have reduced even just to 70%. So for you not to forget, for example, if your account is of $100, okay, you are only able to open trades which reach a maximum of $50 initial margin. And you can check the totals by checking the margin requirements, which I showed you on the settings of the instrument on MetaTrader at that time. So if your money from $100, if your open trades reduce with a loss, if the loss reduces to about $30, meaning that your equity is about $70, some brokers can then send you a message of a warning for your margin, warning you to increase your deposit, to deposit more money into your account whilst there's still some time before you reach the stop out level. Then if now your loss increases to about $50 floating loss, even though your trades won't yet be closed, having only an equity in your account of about $50, your broker may now close the trade or close some of the trades if there will be more than one trade at their discretion, because they will not want you to utilize all your full account, because you remember you will be trading on more of a loan because of the leverage. And the other source that you can even check for margin requirements can also even be the website of your broker. They also even provide that information and it might be maybe on a separate page, so you could just search for whatever the name of your broker will be and then margin requirements, and they can always show you. And they may be different, remember, for different asset classes, and maybe also even they will be different for different instruments. Some currencies will have bigger initial or maintenance margin requirements than others. If you want more information on margin, if you have not fully yet understood it now, you can just research on the internet. You can even find other resources. Then the next type of trading costs are commissions. So commissions are usually charged with brokers which are A booking or which are STP booking. So remember, A booking trades when you're trading is sent your trades to the actual interbank market of the central banks, where there is usually negligible conflict of interest or even none between you and the broker. Then STP booking or straight through processing is when your broker is not counterparty to you and not be booking you, but will be sending your trades to their liquidity provider, which may be a bank which provides liquidity to brokers, but not the actual interbank market, which is the bigger market where even banks can send their trades there. So for STP brokers, they may also give you an option to open a commission-based account. So a commission will be just a fee which you are charged to open and also to close your trade. Then B booking brokers, where your broker creates his own market in which you trade in, will not charge commissions, but will usually just charge only spread instead. And then maybe some of them could just open a slightly bigger spread so that they compensate for them not making money with commissions. But usually B booking brokers, their spread will still be less of a charge compared to the charge of an STP or A booking broker's charge of both the commission and the spread. And because STP or B booking brokers or accounts will have commissions, since they have commissions and make money with commissions, you will see now that their spreads will now be smaller. So that gives you now an advantage if you are a scalper, if you trade on very small time frames, because you can now get better entries on those strategies where you may have a very small drawdown before price goes into profit, or a very small stop loss, to the extent that sometimes your trades could have not been filled if you had a bigger spread, which sometimes you could have on some B booking brokers which don't charge commissions. Now, commissions will differ with brokers, although usually for most brokers these days they will be almost close to insignificant costs. So your broker will usually have the commission charge on their website, And even you can also check for them on MetaTrader if you also go to the properties of the instrument. And even if that will still confuse you, another third way of checking for commissions can also be just opening a random trade on your demo account. If you do that, once you open and then close your trade, if you go to the trade history, there's a section where you can actually see your trade costs for commissions. So for FXView, the commissions can differ with the types of account. So zero commission accounts will just be accounts where the broker wants to only charge spread, because they will not want to charge commissions, because some traders, especially beginners, may be confused with calculating commission costs. So usually this is what are called zero commission accounts. You can see the commission is written $0, but the spreads might be bigger. Then for raw ECN, remember ECN market is just a booking. Okay, if I select they are not opening, so maybe I should have actually used my actual Chrome browser. And then maybe if I open the website on desktop view, maybe it might be able to not have a problem of failing to select the different types of accounts, so you can compare the commissions and the spreads. So even if I go to FXView account types, you will actually even see them there. Okay, so that page is refusing. Let me see if the home page from the browser here won't have a problem. Okay, so I'll look for another website which can show them more clearly later. But your ROS ECN, usually that will be an account which is for people trading with less capital but who want a booking without having bigger spreads, but whilst having the commissions and also the spreads charged on your account. And then the other one, which was written premium ECN, premium accounts or such type accounts are when brokers offer accounts with better trading services, which can be less trading costs, but you will now be someone who should deposit a bigger amount of money into your account. So for example, some brokers may say minimum deposit for their premium accounts or whatever name they may use on their broker may be about 5,000 US dollars. But you now have smaller commissions and maybe smaller spreads. And you should also open, if you are someone who have a very big high win rate in your trades, meaning if you are someone who can trade maybe with like 80% win rate or more, where you win about 80% of your trades or more, you actually also should open the premium accounts whenever you will be able to afford to. Because some brokers, especially booking brokers, if you trade with very good performance, they could actually close your account saying that you should have opened your account as a professional account or premium account, whatever account name they may use for such types of accounts. Okay, I'm not sure why the website is doing this today, but it usually doesn't do this. So you can see the conditions here. Okay, so when you see for the margin and call and stop out levels, you can see it's 70/50. So that's where I was saying that time that margin call at 70% is when they can send you a message telling that you could have to consider looking for more money to deposit. Then stop out level, if it reaches 50% of your total equity account in a loss, they will then close trades on your account. Then for minimum deposits for the premium accounts on FXView, it's $5,000 with a commission of $1 per 100,000. What they mean by $1 per 100,000 is that if you open a trade at one standard lot, you will be charged $1 when you open the trade, and then when you close the trade with using one lot size, you will also be charged another dollar. That's why it's written $1 per 100,000 per side. Remember, 100,000 is just a standard lot leverage. You can see that on the basics of trading whenever researching on trading. 100,000 leverage is a standard lot, and then a mini lot is 10,000 leverage, and then a mini will be 1,000 leverage. So if I come now to the raw ECN account, which is an ECN account for people even with smaller capital, you can see minimum deposit is just $50, and then commission was now higher to be $2 per 100,000 per side. Meaning just that if you open a trade on a 1.00 lot size, you will be charged $2 commission when opening the trade, and then $2 commission also when closing the trade. So in total, it will be a $4 commission, because you can see it's written here $2 per 100,000 per side. One side means either opening the trade or closing the trade. And then if I come to zero commission accounts, which will be the spread accounts for people who won't like the labor of calculating commissions, you can see the commissions will be 0 and the spreads will be higher. Then Islamic accounts, these are accounts for Islams who do not want to use swap fees. since they do not believe in getting loans on interest for their religious reasons. But the brokers will now compensate for that by charging a fixed fee instead of charging the swap fees. There's a certain fee that they will charge, and you will no longer now be able to have those positive swap fees where you can actually make money by being deposited a small amount of money in your account if you open a currency trade where the base currency or the first currency on your currency quote will have a bigger interest rate compared to the second currency on the currency pair, which is the quote currency. So remember that time I was saying that where you can see your commission costs can be on the broker's website. And then also if you come to properties on MetaTrader, okay, there's also a section written commissions, although the way in which they write here sometimes can be a bit confusing. To say 0.004% in US dollars per lot. But another way in which you can estimate them is to just open a trade, a random trade on your demo account. It doesn't matter what direction it will be. And then as soon as you just open the trade, you can just close the trade. Then when you would have done that, you now come to trade history at the bottom of your screen. And then if you come to, okay, now the trade has now come. You will now see that there is a 5 cents commission. So 5 cents commission now includes both opening and closing the trade. But bear in mind that it is when I used 0.01 lot size and also on this currency, GBP USD. Remember, commissions and spreads can be different on different instruments, even if they are of the same asset class. If you would have opened trades of many currencies, if it wasn't just this GBP USD, actually, to make it easier, let me open another trade this time. Okay, I think the stock market is closed now, so it closes at 5 p.m. or 5 p.m. EST. So this is now of a different currency, and I'm also just opening a random trade on the demo account, and then immediately closed it. And I used the smallest lot size, 0.01, so that it will be easy for you to know which one will be, for you to easily know how much cost it will be on trading small accounts. So you can see that the commission cost has increased with 4 cents to now be 9 cents. But in case you have opened many trades in testing those commissions, you can select to see only one particular instrument. So if I select USD JPY, it will only show me now the costs, profits or losses associated just with that instrument. I can then now see even the commission cost. There is just 4 cents, as you can see there. So if you want to read more on commissions, you can even just do your own research in case you have not yet fully understood that. But if it still confuses you a lot, you can just use the spread-based accounts which don't have commissions, which don't charge commissions. For FXView, it was the ones which you saw written 0 commission. Some brokers will use that word, 0 commission accounts. Then another charge or cost you can have in trading are seasonal tendencies. Seasonal tendencies are just price movements which instruments can usually do at certain times of the year, and they don't have to be exactly the same movements, but they can be just more of generalized movements and momentums which they do in certain months of each year. Now, one good source of seasonal tendencies is the More Research Institute, which was started by Steve Moore, and on that website they offer only a few free samples of certain instruments and their seasonal tendencies, but they also have paid services where you can actually subscribe for $50 per month, as you can see written there. And then also, if you want a PDF, which I once downloaded from them, which have some free seasonal tendencies over about 40 years or so, although they were last updated some years back. I can try to look for the PDF and give you, but for their paid services they obviously have more up-to-date seasonal tendencies. So you can actually see that at the bottom of the screen, these are the months, and then you can see that the movements of the blue line and the black line are the movements that price usually does as an average of what it was moving on a number of years. So the blue line is the 15-year average, that one. Then the red line on the lower chart is the 5-year average of how price was moving higher or lower on the number of years. But they actually have some for their paid services where they can be even 40-year averages or 20-year averages. And there are different forms of websites which can offer seasonal tendencies, but that website, the More Research Institute, is the best in terms of accuracy, although you can use other websites for free services if you won't have yet money to pay for the paid services of More Research Institute. One you could use for the free services, which could be better, is barchart.com website. And then another type of trading cost or expense, if you are trading futures types of markets instead of CFDs, which we usually trade here on MetaTrader. With futures, you can pay for live market data. So this will be just live price data which won't be delayed. Whereas if you are to trade without paying for it, you could have price data which may have a delay from coming from the exchange to come to your broker feed. The delay might be of a few minutes, or I'm not sure if seconds, you can always check. But there will be an advantage obviously when trading with live price data, although you could even still trade with the delayed price data. So platforms even like TradingView application, if you can connect your broker account to that trading platform on TradingView, you can also even pay subscriptions on TradingView for you to have live price data, but that is only if you are trading futures instruments. Remember, the ones which expire after every quarter, after every 3 months. And there can be future versions even for stock indices, even for currencies or other asset classes. Now, another type of trading costs you can occur are inactivity fees, but those are only charged to people who would have spent a long time without trading. So usually, if you spend 6 months or maybe 1 year without opening any trade, depending on the broker, what the brokers may now do would be to charge you maybe around $20 per month. After that you will no longer still continue to not open any trades. Or some brokers, after the initial 6 months or 1 year of not opening any trade, will now even charge even $20 per month after that. That is if you will still continue to not open any trades after that. So you can always confirm with your broker by reading the terms and conditions, and they will tell you how they charge the inactivity fees. And the inactivity fees will be taken from the money that will be in your brokerage account. But if you will not have any money in the account, they will not keep a record of any money that you owe them. They will not charge you any inactivity fee if there won't be any money in your account. And then the next trading cost or expense is slippage. So remember, slippage is what I told you, that is just the difference from the price that you would have instructed your trading platform to open your trade to the price that your trade will now actually be opened. Some trades may have slippage, some trades might not have slippage. And slippage sometimes occurs because of low liquidity in the markets, where there will be fewer number of trading participants in the markets, or less volume, where there will be less number of shares or contracts of currencies or futures traded in the market. That may cause your trades now to be filled in on prices which are closer to the ones that you wanted, but not exactly the price that you would have wanted. And sometimes slippage might occur because of manipulations of brokers, especially brokers which will be booking, and maybe especially also if they would have not yet recognized you as a profitable trader before they will now be moving your trades to the actual market. If they are still acting as your counterparty and you are more of like trading against them, your trades could have more significant slippage. And remember that demo accounts may not show slippage, but when now trading in the real market, you will have bigger slippage. And you should also know that even if your broker is not manipulating your trades, when you are trading larger amounts of money, you will have bigger slippages. The more money that you will trade may also incur more slippage when opening your trades, because it will now depend on how much liquidity and volume is on the market of the instrument that you trade or the group of the asset class that you trade. So if you want less slippage, you should start by trading the most traded instruments like your major currency pairs in Forex, or the large cap stocks when trading stocks or equities, which will be just like companies like BMW, Porsche, or McDonald's. And then the lesser traded groups of the asset classes obviously will have more slippage. So the major currency pairs will have the least slippage in Forex. Then the minor currency pairs will have less slippage since they are less traded, and also even bigger spreads. And then the exotic currency pairs may have the worst slippage and also the biggest spreads, since they will be thinly traded markets, which will be to have less volume and less liquidity compared to the other two groups. So you will also have to check regularly when opening your trades to see how much slippage you could be having in your trading, so that you can try to compensate for them by trading your trades when price goes maybe a bit into drawdown, just beyond your entry point. And also note that slippage will be reduced if you use limit orders when opening trades instead of using market execution orders. Remember that when you are opening trades on your trading platform, market execution orders are just opening the trade at the current price, exactly where price will be. Whereas limit orders, if price is below where you shall want to open your trade, you are just instructing your trading platform to open your sell trade when price shall increase up to the price point that you want your trade to open. Then if it will be a buy trade example, price will be above the point with which you shall want to open your trade. Maybe you will want to open your trade at this price level, but currently price will be there. So when price returns and reaches that level, a buy limit order would then open price for a buy trade once it would have reached your entry, even when you are no longer on your device or your computer or your phone, but it will automatically open your trade at that point. So limit orders have the advantage of limiting slippage, and stop orders, which are also another type of pending order besides limit orders, could also have less slippage than market execution orders. Remember, market execution orders open trades exactly where price will currently be at that exact moment. So stop orders, if price is currently down here, we can open our buy stop there. Where price increases there, it will open the buy trade as price goes above that level. So there could be a negative slippage in which price may be opened slightly above your desired entry with a slight disadvantage to you. So the stop orders will be less safe than limit orders in terms of slippage, but sometimes they might be safer than the market execution orders. Although it's not every time that market execution orders will have big slippage. If they won't be low liquidity or low volume, you might not have much problems, or especially if you are trading instruments which usually have good liquidity and good volume, which are traded by many people. You might also not have significant slippage. But remember that also some brokers may cause more slippage because of manipulation, especially if you are trading spread-based accounts or zero commission accounts. If you would be trying to avoid accounts which charge commissions, because brokers on those zero commission accounts, sometimes they do what's called they give your orders to some high frequency traders which may quickly buy your order and quickly sell it in fractions of a second to use your more of like your margin, your money, and that may now cause slippage as you may be given back your order at a less desirable price. So that is one of the things where you should see in trading, that there is no free lunch. Even though the zero commission account may be zero commissions, it can come with a slight disadvantage of bigger slippages. You can always research on what brokers do when sometimes they give your orders on spread-based accounts to those high frequency trading firms, and your order could be sold back to you with a less desirable price. The term is called, I had a page which I opened today which actually has a name that they use for that. Let me see if I can find it easily in my trade history. Okay, so I can't see the website here, but I can always show you in the group. Actually, I will actually even post a link maybe in the comment section of this video on the YouTube channel, and you can always research even more information of it on the internet. But the slippage sometimes might not necessarily, okay, it's called payment for order flow. Okay, some brokers on spread-based accounts offer it your orders to some of these firms which will now do that and offer back the instrument back to you at a less desirable price. These will be the trading costs and expenses that you in trade in your trading. If you have any questions, you can just ask me.